there is a fundamental sort of axiom here that gets ignored or is underappreciated, which is that the green energy agenda is fundamentally incompatible with democracy. Why? You cannot decouple from fossil fuels and nuclear energy without deep cuts in standards of living.
It reminds me a little bit of when I was in college and I was studying modern economic history, and we had to study Stalin's 5-year plan, and the professor was all excited because he could prove that Stalin's 5-year plan was actually internally inconsistent and could not be mathematically achieved, let alone really achieved.
We have a very special panel for you today. Paul Sankey joins Doomberg. We've had them both on the show before, and this is the first time we've had them together, and they're both very well-respected and well-known analysts in the commodity space. We'll be talking about the outlook on energy and some geopolitical events that will possibly move the oil markets and perhaps some other markets as well. Welcome to the show. Welcome both of you, Paul and Doomberg. Thank you for being here.
It's a great pleasure.
Paul Sankey is the president of Sankey Research, and Doomberg, of course, as you know, the head writer of the collective known as Doomberg. You can find him on Substack. Let's start with Doomberg. We've had you on recently, not too long ago, and you were talking about possibly triggers for $200 oil. Geopolitical issues that we can discuss in more detail today. Generally speaking, what is your outlook? Are you still bullish for the remainder of the year, Doomberg?
So when I went back and re-listened to that podcast, actually, I was pretty balanced in my view, with the one exception that if we had a major geopolitical event, you could see oil spike to crazy high levels. Wasn't our base case, still isn't our base case. And I think what we articulated in that last podcast has mostly come true. If we scan the sources of primary energy today, we see oil trading in the lower end of its $70 to $90 range, which seems to be the sweet spot for most people involved, including OPEC and the shale producers. Natural gas is experiencing a supply glut in the U.S. and is relatively well supplied in the rest of the world. Landed LNG prices in Asia are actually a little higher than Europe right now, which is interesting, which is something we could talk about. Coal is a little firm relative to the rest of the primary energy complex when correcting for energy content, which is something we're noticing. But overall, I would say, absent a geopolitical apocalypse, which is always, and especially now with the escalations that are going on in Ukraine, a possibility that one should not discount. All things being equal, physical markets are well supplied. There's a bit of a geopolitical risk premium in oil that has been leaking out lately, which is also catching our attention. But overall, well supplied. If peace were to break out, I think oil would be in the 50s, which I believe I also said last time I came on your show. The prospects for peace don't seem to be growing all that much, especially, I don't know if you saw, but Putin came out with his list of demands today, which was very interesting for us to read. But our overall medium-term view is balanced with a slightly bearish outlook, with the ever-stating caveat of a geopolitics could intervene with that look at any given moment.
And just on that geopolitical caveat, I believe you told me that if Trump were to win, you would expect the geopolitical premium to come down a little bit somewhat, right?
Yeah, I think Trump has committed to, quote, solving the Ukraine problem on day one, and I don't doubt that he probably could, much to the chagrin, perhaps, of the Europeans and the Ukrainians who have fought so hard. But if we take Trump at his word, Trump is a deal maker, and he thinks he can make a deal with Putin. And I think if war went away today, if Israel and Palestine settled down and the risk of escalation with Iran petered out, and we came to some détente with China over Taiwan, and Russia and Ukraine were to settle things, that's a lot of ifs. I don't think oil would be in the $70 to $80 range. It would be much lower.
Before we continue the discussion, I want to take a minute to talk to you about today's sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more.
Right. Paul, can we follow up there? So do you agree, first and foremost, that a Trump win would perhaps be slightly bearish for oil from a geopolitical perspective? And second, your overall outlook for oil for the remainder of the year?
Yeah, I think the market view is that a Trump win is extremely bearish oil, based on two things that he's saying, with a huge offset on the bull side, which is actually just about the one major bull case we can see for oil over the next almost 5 years, actually, just because on the oil side, the supply is so abundant. So the two major issues that Trump is openly talking about are making peace with Putin, which he said he would have done in the first place if he had remained president. He also, with a degree of technical facility, talks about his role in the Nord Stream 2 and stopping the Nord Stream 2. He mentions Keystone XL. So he's talking about stuff that's real and relevant. And he's essentially saying that he would pursue peace with Putin. I think, it's possible that you could read Putin's peace plan today to be the beginnings of a blueprint, at least putting something on the table. And there's a major summit coming up as well. The Swiss are running a non-Russian summit for peace in Ukraine, which is somewhat bizarre. But, so I think that's one major risk on the downside. Now, having said that, you've got to remember that Russian oil and oil products have remained, basically at the same levels as they were pre the invasion. It's just all the routes have had to shift with sanctions. So the physical impact of bringing Russia back in would likely possibly be more on sentiment than on reality. But of course, there is the issue of gas to Europe. And as you know, the Nord Stream is effectively completely destroyed. So the world has shifted without question, even if we do get peace as a result of a Trump presidency. And then on the bull side, the potential for Trump, and again, he's talking about this in his latest podcast, the potential for Trump to crack down on Iran is significant, and that could, significantly reduce the Iranian exports. Trump himself highlights that he told the Chinese not to buy a single barrel of Iranian oil, and they didn't, and he said nobody else did either. And as a result, the Iranians were flat broke as a result of the Trump presidency, and he's talking very much as if that's exactly what he'd do second time around. So those are the two, I think, energy things out there. It gets a bit more convoluted, and Doomberg's brilliant on this subject when you come to regulation. As you know, the US has become quite politicized in terms of the EPA, the Environmental Protection Agency, the FTC, Fair Trade Commission. Unfortunately, highly politicized now, so that could be two big changes. Just as a quick example, in oil, we're waiting for having got approval for Exxon Pioneer, a huge deal. We're waiting for Chevron, Hess, and Diamondback Endeavor, very big deals in the Permian, are all waiting, amongst others, for FTC approval. So that, you never know, might be accelerated.
Okay. I want to bring up a piece of news for both of you. So the IEA has made a projection that has ruffled some feathers in the oil sector. We'll soon live in a world with a staggering excess of oil that we can't fully use, global energy watchdog IEA warns. So it says that the oil demand, according to this article, will gradually slow, hitting its peak by 2029 and plateauing after that. The IEA anticipates the oil supply hitting 114 million barrels a day by the end of the decade, roughly 8 million barrels a day higher than demand. This is the response from OPEC. OPEC's general secretary isn't so sure that things are on the decline. The IEA's forecast was quote-unquote dangerous, says Haitham Al-Ghais, who told the Financial Times on Wednesday, and added that if investors stop pumping money into the oil and gas industry, the resulting energy chaos, quote-unquote, would be on a potentially unprecedented scale. Let's start with you, Doomberg. What's your response to the IEA's forecast and also the response from OPEC?
Sure. We're actually, by coincidence, publishing on this on Sunday. I suppose it's not much of a coincidence. It's the oil headline of the week. And so, of course, we would be interested to write about it. We are going to argue that the IEA is partially right, but for the wrong reason. We do think that the oil markets will be really well supplied for the next 3 or 4 years, and that will lead to a cap on, say, the equilibrium price of oil going forward, again, with the standard caveat of geopolitics, but not because of lack of demand. In our view, which is what we articulate in the piece, the gating function for demand is production. And by the way, the 114 million barrels that you quoted it in that article, actually, the IEA is quoting capacity, not production, which is a really important asterisk to put on all of this analysis. Look, the leader of the IEA has taken that organization to a decidedly political stance. It used to be known for its impartiality and its data quality, and both of those things have dissipated, at least reputationally, in the past 5 to 6 years, certainly since he became the president, or whatever his title is, of the IEH. And so we write about this in the piece, but what's really going on, in our view, is we're seeing the definition of oil expanding to include light liquid hydrocarbons and natural gas itself. We're seeing engine switching. I would note that a really interesting article hit in Bloomberg last week, which said that 1 out of every 3 long-haul trucks in China is now being powered by natural gas, and the demand for natural gas in the shipping industry is up tenfold in Singapore year over year. What happens when you have vast arbitrage in oil and natural gas is they either convert natural gas into oil products, or they switch the engines and they burn natural gas. And once you sort of lay that groundwork, both technically and investment-wise, financially, that's pretty permanent. And some estimates are that 800,000 barrels per day of diesel have been displaced in China alone as a consequence of this switch to natural gas. In our view, oil should be defined as any hydrocarbon that finds its way into a refinery or is burned for the same purpose that oil is burned for. And we're seeing the broadening of the definition of oil, and there's a superabundance of natural gas all around the world, and it doesn't take much. So the last point I would say is, when you look at commodities, there are 2 words you need to keep in mind at all times. And those 2 words are elasticity and fungibility. Because of the highly inelastic nature of commodities, it doesn't take much in the way of fungibility for prices to normalize, for equilibrium to be established. And ultimately, in the long run, all hydrocarbons will trade for the same price, correcting for their inherent energy content and logistical complexities. And natural gas is slowly but meaningfully becoming quote unquote oil. And this is going to radically alter the way in which the energy markets play out in the next 5 to 10 years.
Okay. Paul, what are your thoughts on this supply gap coming up in the future?
Well, yeah, the timing was important, because OPEC had just had their meeting where they kind of put out a roadmap for how much they'd like to produce. I think you could say, I mean, it's controversial. The market reacted very bearishly to OPEC wanting to add more oil. And the reason for that is that partly the spare capacity that you just referenced has always been an overhang, and it's just a question of how long Saudi is prepared to hold over 2 million barrels a day of spare capacity rather than produce it. And the resumption of growth in UAE, who traditionally has been Saudi's biggest supporter within OPEC. So the biggest single Saudi supporter within OPEC, which is pretty dwindled now, by the way, because you don't have a quota for Iran. You barely include Iraq, in fact, but that's a separate subject. You don't have a quota for Venezuela. And as a result, the math is already weakened. And on top of that, exactly further to what Doomberg was saying, they're talking about black crude oil, what we call black oil, which is literally crude oil, which is about 30 million barrels a day in the case of OPEC, whereas the global oil market is 102.5 million barrels a day. So you're not really addressing the large part of the market which we're moving towards in an electrifying world, which would be, as mentioned, for example, potentially more gas in vehicles, natural gas in vehicles, which is a tough one, but certainly more gas to power to electric vehicles. So what the IEA, I used to work at the IEA. I started out of college at the IEA, working on long-term energy demand forecasts as much as anything, actually. And, there was always a major problem, which was price. So essentially, the prophecy is totally self-defeating anyway, because if that really happens, it won't happen, if you know what I mean. Because if you were to have 8 million barrels a day of spare capacity globally, you would have to price out 8 million barrels a day of spare capacity before you got there, because that would be way too much. You know what I mean? I'm not going to labor the point. And it always struck me, especially when we did the first World Energy Outlooks at the IEA in the early 90s, that they just gave us a flat price assumption and told us to model the world energy market. And from the flat price, which at the time would have been sort of $20 a barrel crude, keeping in mind the price today is closer to $80 a barrel. We derived that China would, by 2015, which was the end of the forecast period, be using 70 million barrels a day of oil, which was interesting because the entire global oil market in 1990 was that level. So and we were going to add an entire new oil market, which actually, crazily enough, we kind of did if you include their growth in coal demand. So over time, what you came to realize is that price will solve for this, and that's why we're bearish price, and why you mentioned at the beginning, you said I was a commodities analyst. I'm actually an equity analyst, as well as having to follow the commodity that the companies I cover produce, which is oil. Essentially, the oil equities have sold off, starting with the OPEC meeting and accelerated by the IEA, essentially just on the basis that what the IEA is reminding everyone is that there's too much oil supply and too much oil supply growth, even with all-time high world oil demand. And it's a challenge because a lot of that oil outside of OPEC is long cycle oil. So that's oil that essentially you develop on a 10 to 15 year view, for example, in Guyana. And once you develop it, once you're committed to development, you produce the oil regardless of price. And that's obviously low price elasticity oil, which will be produced regardless. It's also low break-even price oil. So the Guyanese projects are in the range of $30 Brent to be profitable. And Brent's at 80. So they're very profitable. That growth, which is going to come from Brazil, Guyana, Canada, and ultimately the US as well, potentially, is all in the face of literally no room for OPEC, because OPEC's already got 2 million barrels a day spare at least. So there's a traffic accident that's implicit in oil. And as I said to start, the only real big way of getting around the supply problem, because it is an excess supply problem, is going to be by stopping Iranian exports or by reducing activity in the US shale. And that's going to be a tough price, probably well below 60, below 50, before these very rich companies now with strong balance sheets, the Exxons, Chevrons, and Conocos of the world, actually change their plans and begin to spend less money. So into the Trump presidency, should it be a Trump presidency, it looks like there'll be a major oversupply of oil, barring action against Iran, more or less all things being equal. And that's essentially what the IEA has kind of extrapolated into a 2030 view, that, as I said, is kind of meaningless because they don't address what would happen to the price. They do have stuff in the report, to their credit, which tells you that demand would be higher in a very low price environment, and they show that working. So they're not, ignoring price. It's just that they're not, it should be calculated more dynamically to show that we would be heading to very low oil prices as a conclusion. And they kind of back off making that because it seemed to be too politicized, believe it or not. They're always reluctant to talk about oil prices.
Doomberg, do you have a response to that before we move on?
Yeah, I would also say that the way we come out of what Paul just described, which, by the way, I wholeheartedly agree with, is, of course, the global south begins to consume more oil because it's cheaper and more readily available to them. And energy is life, and everybody would like a better life. And you can't impose order on your local environment without creating waste heat. And the way you do that is you burn hydrocarbons. And so what we would see on the back end is the 6 or 7 billion people that live well below our standard of living, as measured by BTU per capita, would happily and greedily burn $20, $30, $40 a barrel oil, as much as we could supply to them, and that would be the outlet for it. And then we would slip back into a temporary shortage. Our worldview is that the demand for all forms of energy are additive. So like this whole concept in the IEA report, which we find ludicrous, is that somehow oil demand will be displaced by electric vehicles or other renewable technologies. What in reality would happen is, as we articulate in what we call Doomberg's postulate, is that every molecule of fossil fuels produced in the world will be burned by somebody somewhere. And the local restrictions against such activities only change who gets to enjoy that privilege. And so there's billions of people in the world that live on less than a fifth of the BTU footprint that those of us in the West get to enjoy. And in the scenario where for a couple of years we have excess capacity and oil prices begin to flounder a little bit, both in nominal terms, but actually in inflation adjusted terms, oil is already incredibly cheap. Using the Bloomberg Inflation Index, oil is actually like $24 a barrel today in 1983 money, which is basically free to the Western consumer. There are poor people in the world who would like to climb Maslow's hierarchy of needs. And in a world where we have an excess capacity of oil, the correction for low prices is low prices, and they will soak up that incremental supply to climb the standard of living ladder. And who are we to deny them?
There seems to be, Paul, I'll move on to you now to comment on this next series of articles. There seems to be a movement to shift away from certain green policies in some jurisdictions around the world. So in New Zealand, for example, this article states that the government to reverse oil and gas exploration ban, removing the ban on petroleum exploration beyond onshore Taranaki is part of a suite of proposed amendments to the Crown Minerals Act deal with the energy security challenges posed by rapidly declining natural gas reserves, says the resource of the Ministry of Resources. In New York, they are also indefinitely postponing a congestion fee. And in all over the EU, Green parties seem to be losing traction in elections. Is there sort of a reversal in a broader trend, a reversal of certain green policies and enforcement actions around the world, Paul?
Oh yeah, absolutely. I mean, it's we talked about peak ESG in 2021, I think it was, when there was full-scale hysteria about anything that was, let's say low carbon or, really anything that was seen as part of the energy transition, led by, Tesla and everything beyond into solar stocks, you name it. And, I guess we all slightly sighed. Oil was well, in 21 getting better, but obviously we were a year away from negative prices. And, it was tough to have to deal with that requirement by many clients not to invest in oil. I mean, it was definitely an issue. My clients are major money managers. And, it was clear that some of them simply couldn't own any oil stock whatsoever. I think that there were two things that changed, and the biggest was obviously the Russian invasion of Ukraine. Jane, I've embarrassed myself, I forget her surname, but she's the CEO of Citigroup. I want to call her Jane or Janet. I apologize for not remembering her surname. She described ESG as now the S in ESG stands for security. And I thought this was, a brilliant comment that really summed up the fact that a lot of places like New Zealand, you mentioned, where you had a relatively small domestic energy supply, realized that to go to absolutely zero would be a big mistake. And I think that they're beginning to kind of recognize that in the UK as well. In fact, this whole issue has become a major issue for the election between Conservative and Labour. And I think both sides have basically shifted the axis back. Now, of course, the bizarre situation in New York is something completely different. That's just incompetence. And in fact, I said, and I'm ashamed to admit it, but I said this is the first time in 20 years that I feel like actually joining a protest that I read about in the New York Post, because inexplicably she just, I don't know what she was thinking, but essentially she just abruptly cancelled it. And everybody, but I live just outside the zone, so in theory I should oppose it according to the idea that it makes my air quality worse, which, by the way, is, right here by the sea, where the air quality is absolutely excellent. The idea that this would suddenly be cancelled caused quite a major demonstration pro the congestion charge in New York last week, and I was very tempted to join, except I work on Sundays, so I couldn't. Anyway, the general theme has definitely moved away from ESG because of the obvious energy challenges. And as Doomberg himself will tell you, he's an expert in energy density. I think people are just waking up to the fact that it's not as easy as building a whole load of solar panels and windmills, not least because of the environmental impact they have in their own way, especially being built in China, but also just the whole challenge of meeting the energy density of what we use today, with much less baseload supply that really can't meet 24/7 demand. It's as simple as that. And I think 5 years ago, people kind of didn't get that, believe it or not, but that shows you the level of energy education that was out there. We always said the only conspiracy in oil is a conspiracy of ignorance on the part of US consumers. And, I think that now people, and Greta, I think, has done a huge part of this, that people are actually much, much better informed. And making that recognition, realize that, if you want to have an iPhone, you're probably going to have a lot of gas-fired power, and you're already at this moment still dependent on coal. And, people now, I think, understand that.
Doomberg, Paul used the words big mistake when referencing a drop to zero emissions. Can you just explain in layman terms, what is this big mistake from an economic perspective here? So just explain to the audience, please, why can't we as economies, societies, just galvanize all industries to meet these demands and prioritize these demands by 2030, 2035, whatever the deadlines may be? Presumably, if we can industrialize an entire nation for a world war, can't we do the same to meet climate goals?
There's only one way to do that, which is to be basically exclusively pro-nuclear. I'd take a step back. We would say, first of all, I agree with everything Paul said, and I will add to it. There is a fundamental sort of axiom here that gets ignored or is underappreciated, which is that the green energy agenda is fundamentally incompatible with democracy. Why? You cannot decouple from fossil fuels and nuclear energy. Certainly, unlikely you could decouple from fossil fuels, but you can't decouple from both without deep cuts in standards of living. Lower standards of living are deeply unpopular, and democracies are popularity contests. And so what we're seeing right now is the perfectly rational populism uprising. The word populism is popular against the green energy agenda, because if you take away fossil fuels and nuclear energy, as Paul described, and your only alternative is to replace them with intermittent renewables that have low energy densities, questionable energy payback periods, and are totally dependent upon China for key supply chain choke points, you're going to get reductions in standard of living. And that's what we're seeing in Germany. That's what we're seeing in the UK. And the flip side of that, I would argue, is India, who has greedily lapped up every barrel of oil from Russia they can get their hands on as a consequence of the sanctions, and their economy is booming. And so, like this, the big lie, as we call it, there's a big giant lie at the heart of the green energy movement, which is we can shift from fossil fuels to predominantly renewable, quote unquote, which is, of course, I think a misnomer, sources of energy with no sacrifices to our standards of living. That's the big lie. You can shift to 100% renewable. You could do a Manhattan Project, as you described, and we could all agree that we're going to be living at 40 to 60% of the standard of living that we had before. The big lie is we've sold the population that they can do that and maintain or even grow their current standard of living, green jobs and all this nonsense. That's just physics. Like would a simple physics calculation dictates that this is impossible. And so we've not sold it as a sacrifice for the good of the planet. We've sold it as we're going to ruin the planet because of greedy fossil fuel companies. And if you just let us impose these policies, you will have the same standard of living and the planet will be saved. Well, that's just not true. And so the word that's missing from the environmental debate is trade-off. We don't talk about trade-offs. And if we did, we could have an adult, rational conversation of how much of our standard of living are we willing to sacrifice in the name of carbon emissions that might hurt the planet or might not hurt the planet 40 to 50 years from now.
I'm going to move on to Paul in just a minute, but just to follow up, Doomberg, no doubt you've heard rumors or the news that California is looking into ways to supplement their lost revenues from EV sales, because so many people are driving EVs now in California that they're losing gas revenue from the gas pumps. Have you heard about this?
Yeah, sure. I mean, road taxes. I mean, the way in which the national highway system was funded was a combination of taxes by users, which I think is actually a pretty fair and progressive way to fund public works projects like the interstate highway system, which is really, the legacy of Eisenhower in this regard is incredible. But in order to stoke the initial demand for EVs, copious amounts of government funding via tax credits or getting to ride in the low occupancy lanes or high occupancy lanes, and not having to pay taxes on fuel and so on. These things are, of course, government interference in an otherwise free market. And what you have when you suppress prices is you temporarily increase demand for those products. But now, ultimately, the roads, which, by the way, heavier EVs tend to cause wear a little quicker. These roads that still need to be repaired, somebody still needs to pay that. And the challenge is, if you're going to put that upon the shoulders of the EV drivers, that makes the artificially low price of EV slightly higher, which then, of course, runs counter to the desire to increase their market penetration.
Paul, I'll move on to you. So just to follow up there, EV sales and emissions targets. I live in Canada. This is from the government of Canada's website. To help decarbonize the transportation sector, we need to accelerate the adoption of zero-emission EVs. That is why the government of Canada committed to achieving a 100% zero-emission vehicle sales by 2035 for all new light-duty vehicles, including interim targets of at least 20% by 2026 and at least 60% by 2030, as announced in Canada's 2030 emissions reduction plan. So let's just hypothetically reverse engineer this result. Zero emissions by 2035. What needs to be done to our grid, transportation sector, infrastructure, energy production, EV sales, so on and so forth?
Well, actually, you can go to the IEA for that because they have, a roadmap for how to get to net zero, and it's pretty mind blowing. It's really not physically possible, but they do lay out all of that out. It reminds me a little bit of when I was in college and I was studying modern economic history, and we had to study Stalin's 5-year plan. And the professor was all excited because he could prove that Stalin's 5-year plan was actually internally inconsistent and could not be mathematically achieved, let alone really achieved. You have to remember that California had an all-electric vehicle standard in the 80s, and they got nowhere near meeting it and cancelled it. And that's my prediction. I think one of the hardest things here, unquestionably, is that it's clear that consumers don't have the appetite for EVs outside of China, where, further to Doomberg's point about democracy, you can have a very comprehensive energy policy because you're a totalitarian state, and you can argue that if they would only make me the dictator of the US I promise I would only do it for a year, we could make it, Doomberg could do it too. It could make an enormous amount of differences, especially given the ignorance of politicians regarding energy and the fact that they pick oil as a whipping boy, essentially because Texas is red, and so it's not an important swing vote. We should certainly revolutionize our farming subsidies and excessive support for monoculture of corn. There's a lot of things that should be sorted out that won't be, but I will tell you that it's going to be impossible to meet these EV standards, and the biggest single reason will be that people don't want to buy them.
Sorry, I don't mean to interject, but I'll let you continue. But the IEA's projection that there's going to be a supply glut and I guess less demand than what actually is that factoring in these targets, these zero emissions targets? Is that assuming that these will be met?
Somewhat. You can read, actually. I mean, there's a number of different documents from the IEA. The one that we're referring to is the medium-term oil market report, and they'll cover that, I'm sure. You can just get the PDF, although it should be free. I think, I'll break the rules and send people it free if they really want it, but because the IEA should not be charging for this stuff, it's paid for by OECD taxpayers. Anyway, the IEA report, it will outline the fact that there'll be scenarios of EV penetration, absolutely, in the 2030 outlook, and they're probably too aggressive. Doomberg might have a better idea on that if he's been studying their report and deconstructing it.
Yeah, I could add some color, which I think is interesting. So what happens when somebody buys an EV in the US? Well, that means that a internal combustion engine vehicle is then sold on the used car market, and then at the very end of that chain, a used car vehicle is then exported to the third world, where it is considered an extreme luxury. And so we wrote a piece many moons ago, I forget the name, but the life expectancy of an internal combustion engine in the US is maybe 12, 13 years. But then after those 12 or 13 years, a good many of them, either directly or through sort of a Frankenstein parts combination, there's a whole ecosystem of people who export end-of-life cars from the West, which become a huge increase in the standard of living for the billions of people who are struggling in the emerging economies. And so these engines aren't leaving the global world, which is my point. And so if the IEA projections come true, there's no shortage of internal combustion engines all over the world in the emerging economy that were born in the US, in Europe, in Japan, in Korea, in Russia, and are now sitting in, Indonesia and Iran and African countries and Caribbean countries, where they will greedily and happily buy every incremental gallon of diesel or gasoline that we don't buy in the West. And so if you actually look at the total number of internal combustion engines in operation around the world today, that is an ever-increasing number. And if EVs displace some of the new builds, that doesn't mean the fleet of ICEs shrinks. It won't.
I'll throw this next question out to whoever wants to take it. So you both mentioned that consumers may not, part of the problem is that consumers are moving away from EVs as their personal preference. Yes, part of the problem for that, not only is it because of an infrastructure problem, because also they're expensive, right? Why are we putting tariffs? By we, I mean the U.S. and the EU on Chinese EVs. China is now the world's largest producer of EVs. Biden's moving towards 100% tariff on Chinese EVs. The European Union already is moving from 17, or there's a range from 17% to 38%, depending on the place. Wouldn't removing trade restrictions partly solve this problem?
Well, I could probably take this because we've written about it multiple times in the past few months. Look, here's China's strategy when it wants to dominate industry. Entice the Western market leaders into their country, steal all their technology, take the best of everybody's technology and put it in one domestic state-owned enterprise, local champion, and then they dominate the world. And that's exactly what we've seen in EVs. And the reason why we're putting up these tariffs, of course, is because of the strength of the unions in the Volkswagens and the General Motors and the Fords of the world. Mm-hmm. This is a major problem. This is an exercise in barn door closing, by the way, because again, these large Western automakers are capitalized to sell to the world, and the global South will happily buy stolen technology from China at 1/5 of the cost, or 1/4 of the cost, or 1/3 of the cost than what we could do over here with our environmental standards and our labor standards. Mm-hmm. And so we've lost that war. And per your point, it is a trade-off. We are deciding whether we want to achieve our quote-unquote climate goals, or do we want to protect domestic manufacturing.
It does seem to me kind of hypocritical that the politicians are enacting these standards, but at the same time enacting these really high trade restrictions. But I'll let you continue.
Well, I mean, just look at the solar industry. We allowed China to illegally steal all of the intellectual property of the Western company. Believe me, I was in the industry when this happened 15 years ago. And now they own 95 to 99% of key choke points in the early parts of the polysilicon supply chain, including ignite and wafering and cells. And then now we're like, on the one hand, with the Inflation Reduction Act, mandating that we install all this solar, and then on the other hand, trying to impose tariffs on the Chinese supply, which is the only game in town because we let them win. And then I read a fascinating article a couple of weeks ago. We're trying to put tariffs on China in the U.S. so that we can rebuild our homegrown polysilicon supply chain that we never should have let get taken over in the way in which it was. But we can't because China has 100% supply on the machines that you need to install in your factories to participate in that part of the supply chain. And so they run circles around us all the time. This is a theme in like 4 or 5 of our recent pieces. That when the Chinese Communist Party decides it wants to own a supply chain, they play to win. They don't play by rules that we respect, and we lose.
I want to move on to another topic now and finish off here. The petrodollar. There seems to be a lot of misreporting on the internet, on social media. This is, I think this blog from UBS summarizes it quite well. So it was reported that an official 50-year agreement between Saudi Arabia and the U.S. ended on June 9th. This is what actually happens. The U.S. and Saudi Arabia did establish a joint commission, I'm reading this report, for economic cooperation in June 1974. This aim was to help Saudi Arabia spend its sudden glut of U.S. dollars on U.S. products. In July of that year, Saudi agreed to invest oil dollars in U.S. treasuries. Oil has always been trading in non-U.S. currencies. In January 2023, Saudi indicated it was happy to negotiate oil sales in other currencies. The possibility changes little for financial markets. Saudi Arabia's rial remains pegged to the U.S. dollar, and its stock of financial assets are dollar-focused. So, Paul, I'll start with you. What actually happened here? And we'll talk about the impacts on either the dollar or oil.
Yeah, the terms, whether there was an agreement or not and everything else is quite controversial, and it's actually on my list of things to really dig into as to whether this existed or not. As you mentioned, the crucial point is that Saudi currency remains pegged to the dollar, and the functional currency of the global oil industry, which would be, making investments and everything else, as well as selling the final product to each other, is essentially all dollar denominated and can be, surprisingly dollar denominated, such as historically Russian gas exports to Europe, weirdly enough, were dollar denominated. But of course, you have such a big global economy now that you do have the development of Russia selling directly to China and other things that in theory would weaken the petrodollar. And they certainly would have greatly weakened the dollar if the US hadn't had the US unconventional revolution, which is, wildly underestimated, in my opinion, in many people's view of the world, including their view of the importance of this so-called Saudi agreement. Because in reality, it's not that relevant anymore, because the biggest oil and gas producer in the world by some way is the United States of America. And that was a very long way from the truth, not only 20 years, 30 years ago when this deal was signed, but also just 10 years ago. So the change has been absolutely remarkable. And one of the things that we ponder in markets is that the dollar now seems to positively correlate with oil prices, where historically, for similar reasons that you've outlined in terms of theories about petrodollars, it was always seen that the dollar negatively correlated to the oil price. If you look since the Russian invasion of Ukraine, which makes perfect sense, and it's wonderful when this happens on a chart and you can realize what's happened, you actually flip from a negative correlation of oil to the dollar to a positive correlation, because the massively increased unintended consequence of Putin's invasion was to make the US the dominant hydrocarbon supplier in the world. And we do a good job in coal as well, by the way. So the bottom line is I don't think it's as relevant as people make it out to be, because the world is so much different today than it was in 74. But, there's plenty of people that will point to things like gold going crazy. The yen is really important and is falling out of bed, which is interesting, having not done so for what feels like it should have been 20 years. The list goes on, but generally speaking, I think I kind of come to the conclusion that we're at a different point of the market here today, and it's structurally different, and that is a positive correlation of oil to the dollar, and none of this matters.
Doomberg,
wrong.
Absolutely. No, thank you, Paul. So Doomberg, the narrative I'm seeing on social media is that this is just another peg in the domino effect of de-dollarization. Can you comment on what actually is going on here?
So I'll start by saying I agree with what Paul said, and I'd like to build on it, which is, in reality, the currency in which various international trade agreements or transactions is denominated in isn't as important as how imbalances in trade are settled. And I think if you replace US dollar with US treasuries, and you replace transactions with imbalances, all roads lead to gold, which I think explains why gold has been on a tear lately. And I think there is a move, not necessarily away from the dollar in US transactions, or that such a move would be important, but what energy producers and energy buyers save their excess, trade gains in matters a lot more than whether they buy and sell in U.S. dollars. And so the actual consequence of the agreement, whether it exists or not, and I should say, in the 1970s, I wasn't, when this deal was struck, I wasn't born. So let's put it that way. So I can't say that I have a deep understanding of what happened in 1973. But in reality, the deal was that the Saudis would recycle their profits from oil trade into U.S. treasuries. And then the U.S. as sort of the reserve currency and also the issuer of the neutral reserve asset in the sort of settling of international trade, required that the excess profits from oil would be recycled into those treasuries. That kept our interest rates lower than perhaps our deficits or our monetary policy would otherwise indicate if we were, say, an emerging economy and so on. And in exchange, of course, the U.S. protected the open and free trade of oil across various naval choke points around the world. And so what we're seeing right now via the BRICS is not towards a replacement of the U.S. dollar. It is towards the replacement of U.S. treasuries as the neutral reserve asset in the settlement of international trade imbalances. And I think that is actually much more real than whether or not Saudi Arabia is selling oil to China in the RMB. And so that's our view of the world. And by the way, I should say, just for full disclosure, this is a view that we have come to agree with Luke Groman on, who was the first place that we read about it many years ago. And I think he deserves good credit for the work he's done over the years. And so I don't like to articulate the views of others that I have learned from without at least giving them credit for it.
Well, ultimately, does this shift in use of currencies or treasuries have any impact on OPEC production?
I don't think so. I think OPEC is reaching a critical point, which is how we open this whole conversation, really, which is who amongst them is going to be the first to cheat measurably. Because as oil begins to reach equilibrium and geopolitical risk leaks out, the spare capacity, quote unquote, as we were talking about earlier, the consolidation in the Permian means that we have adults in charge now of the spare capacity. But even there, and in Guyana and all the other places that we've mentioned, when the price that you need to be profitable at is different than the cash profitability, right? And so does the incremental barrel of production bring me more cash than I have today, even though from an accounting perspective, I quote unquote lose money? The cash break-even price is much higher than the profit break-even price from a GAAP accounting perspective. Right. And so the temptation to produce the marginal barrel because I have a domestic funding need to take care of, or I've got some people I need to pay off so that my position in power is secured. We're getting to the point now where the game theory within OPEC, which always happens when they are losing incremental market power, which they are today, could result in a sort of a domino effect where one side cheats and everyone else decides to cheat, and the entire point of the cartel, at least, is undermined temporarily.
Paul, finally, moving on to you. This story came in 2 years ago. Saudi Arabia considers accepting yuan instead of dollars for Chinese oil sales. So Saudi Arabia is in active talks, or was, with Riyadh, or with Beijing rather, to price some of its oil sales in the Chinese yuan. People familiar with the matter said a move that would dent the U.S. dollar's dominance. This was again in 2022. Does this petrodollar story underlie a larger geopolitical shift?
Yeah, no, I think that, and again, I'm on the same hosting platform as Luke Groman mentioned earlier, and know him a bit in terms of this very macro worldview where everything is interlinked. And yeah, absolutely, the Saudis and the Chinese are doing their own deal. I think Saudi is very oriented towards the east now, and is barely supplying oil to the US any longer. In fact, it's down, I think, to as little as 300,000 barrels a day from close to 3 million barrels a day maybe 10 or 15 years ago. I'd have to check those numbers, but they're not crazy. So yeah, Saudi is barely supplying the US any longer because we're self-sufficient in oil, and their trade relations and their development and their spending in terms of Aramco are all downstream in places like India, Pakistan, China, so you can see the way they're going. I think ultimately Doomberg made the point directly after what I said, that all of this boils down, and the single biggest driver of this entire market boils down to the market appetite for T-bills and where interest rates go. If you just blew your brains out printing $7 trillion or whatever we just did, how does that all hang together? And the example of Japan is interesting because in theory we should have had a much weaker yen much sooner than we otherwise did. I mean, it took 20 years. And so by the same token, it's very hard to second guess how long printing this much dollars into an economy of the scale of the US will just continue to circulate and multiply, which is what you see today. And that becomes the biggest single question. At the margin, you'd have to say all of these things are undermining, as Doomberg pointed out, the appetite for treasuries, which has significant impact on things like fiat currency. I mean, you name it, you go off into a whole different new set of things. One point I make specific to oil is that the futures price of oil is priced nominally. So the market at the moment is pricing oil, let me see here, for, let's say, 2 years ahead, a good couple of dollars a barrel below where we're trading today. And that is a nominal price, right? So if you were to disinflate, you'd have to take out inflation from the dollars. You've got an even lower in price by future price of oil, which is interesting, and I don't think is right. I think that the price of oil has to inflate over time based on dollarized markets and everything else you're talking about, even though I'm very uncertain to say that because the fundamentals look so strongly oversupplied. I'd add a further point, which is it's quite logical in terms of the ongoing technological improvements we see globally, with AI being the obvious current example, that oil would come under pressure from both sides, both from greater efficiency of use, which is already very weak, it can only get better, particularly in the US. So you get more efficient demand with technology, and you also get much more supply. And that does seem to be playing out. So I think the one thing the two things that really look bullish for oil here would be what you're talking about with de-dollarization or other impacts of fiat currencies on the actual price. And so it becomes, what's the real price of oil and what's the nominal price? And at the moment, they seem to be upside down. That would be a key element. And the second I mentioned already is whether or not you shut down Iran. But those are my two things. There you go.
Okay. Anything to add to that, Doomberg?
Freudian slip, yeah.
Yeah.
No, I agree, and I do look at futures curves a lot, and I agree with Paul. I think where we started this conversation was I think Paul and I share a view that for the next several years, absent geopolitics, we're in a situation where any micro spikes in oil will be met by capacity on the sidelines, waiting to come back. And so, it is not, the most bullish outlook in the next, again, 18 to 24 months. We're not talking 10 years from now. I think, again, the oil demand supply sort of balance is an upward sloping sine wave that grows 2% a year. It has done so for 50 years and will do so for the next 50 years, in our view. But we're at this point right now. We're at the sort of the bottom dip of that sine wave, and that's the market outlook that needs to happen.
Right. Well, gentlemen, I appreciate both of you participating in this panel. It was an excellent discussion. Tell us where we can find your work, Paul.
SankeyResearch.com is the name of the website. Everything's published there. You can actually sign up for free, I think. But eventually, if you read a lot, we'll ask you to pay. SankeyResearch.com. Thanks a lot, David. Appreciate your interview.
Thank you. And Doomberg?
Yeah, first of all, I want to say I could talk energy with you and Paul for hours at a time.
Yes.
The time flew by. It was a great pleasure. I'm a big fan of Paul's work, and everybody listening should go and subscribe. And then if you still have budget after signing up for Paul's work, you can come over to Doomberg.com. That's where you'll find everything that we do. David, always a pleasure. You're a real pro. Congratulations on your success, and
Thank you very much.
Happy to be a guest on your show anytime you'll have us back.
Thank you. And congratulations on both of you doing so well in the energy sector. You're both respective voices, so please follow both Doomberg and Paul Sankey in the links down below. Thank you for watching. We'll stay tuned for next time.